You watch metals and markets every week, yet still shop with the big guys? Why pay more for your precious metals from the guys who have offices on Wall Street and who bank with JP Morgan? From the basics like eagles, maples, rounds, and bars, to collector coins like Silver Shield and Heroes, SD War Collection, to our exclusive new line of insurance, approved, TL-rated precious metal safes, SD Bullion is what you're looking for. At the lowest prices, period. Guaranteed! Because if you don't hold it, you don't own it. SD Bullion, founded by stackers to help you prepare for what's coming. Shop with the Doc today at sdbullion.com.
This is the Doc and Eric Dubin with the SD Weekly Metals and Markets Wrap. Well, Eric, the Chinese New Year has ended, and not surprisingly, it appears that so has the gold and silver, a month-long correction, coinciding really precisely with Asia opening at the end of the new year. Gold spiked back above 1,200. It's held on to that throughout the second half of the week. On Fridays, trading here, Thursday and Friday, traded right around 1,220 before pulling back a little bit. Silver also not quite as strong as gold, but jumping well off of the 16 level it flirted with, trading on Thursday up towards 1690, and here on Friday trading above the 1650 level. So what's your take here, Eric, as China is back in the physical market? Have we seen the bottom? I know about a month ago we were chatting before the show. You and I were both looking for a correction to what had become a bit of an overheated rally, particularly in silver. The two of us really didn't foresee the correction lasting quite as long as it has. What's your take here now as we close out February and enter March?
Yeah, you and I talked, and then also Dave Kranzler came on, and we were talking early, I think it was early, like February 1st or something like that, if I forget the exact date. Our expectation was that we would see a pretty quick rebound, and I was looking for February 9th being the last day at which we'd finally see some stabilization, because that typically would provide enough days of healing following the vicious attacks that we saw in the end of January with the close of the February contracts on COMEX, and after the momentum peak that peaked out around the 21st, 22nd of January, when even conventional Wall Street type thinkers, the guys that don't read zero heads, that don't read blogs like Kranzler's or Silver Doctors, etc., were in fact jumping into the gold market pretty quickly. I mean, not a gigantic move or anything, and to a large extent most of Wall Street still hates gold, but it was still nonetheless interesting that the ETFs representing the gold trusts had pulled down something like $500 million worth of secondary offerings to buy more gold to meet the demand that was coming into principally GLD. So, the average Wall Street type thinker and conventional thinker out there was actually beginning to come back into gold, which is interesting. All of that momentum that hit in January has kind of fizzled out now, and it's been a fortuitous kind of reset, because it kind of sets the stage for yet another move back into gold and silver, when there's not much froth in the market at all, and people have had diminished expectations from that experience in the latter portion of January. So here we are. We've seen China go on vacation for about a week, and the gold cartel go and do their thing, beating down the markets, and China came back Wednesday morning, our time in the United States, and I was actually posting on the Silver Doctors Facebook page in real time when all of these developments have happened in the last 3 days, where for the first 2 days after China's return, you could see the buying that would come in the early morning hours, just past midnight Eastern Standard Time, and then be taken down to some extent when London trading would proceed and COMEX trading thereafter. And that was the pattern that we saw from Wednesday, Thursday on. And today, what's interesting is that even though the cartel presumably, most likely, I can't tell 100% with certainty, but it appears that the trading in the same window of early morning hours U.S. time and main hours in the early morning trading for China's open had the gold price going up, but nonetheless, if you look at the 72-hour chart, you can see, which reflects, the overall futures trading markets worldwide and the OTC market, you can see that the trace of the pattern over the last 3 days, one, had, a very constrained trading pattern where the prices were moving pretty much in lockstep in the same kind of pattern, which strongly suggests that even though there was some buying, there still were algo programs managing that buying and managing the price as the cartel does. And, the average Wall Street thinker would hear that and say, you're talking smack, this is nonsense. But, anybody that looks at these patterns over the course of the last 10 plus years will see what I'm talking about, and I think our audience wouldn't question what I'm saying. So we'll conclude the link to the Facebook posts that I was making, and you can see these patterns. And the take-home point that's really relevant for today is that even though algo patterns were capping in the Asian trade and trying to constrain it, and then ultimately we saw a downburst before London's open this morning, which is cartel-driven, the price is still doing pretty darn well. Through COMEX trading as we record, and we're recording just after noon Eastern Standard Time Friday, gold has come back to some extent, and I think that reflects that there are now some of these paper traders on COMEX that actually know this cartel ritual that we go through every month with the contracts, coming towards expiration, and then the bombing that happens in association with that, and that some of these guys are now willing to actually play that cycle. And we are very early in the game for this month with respect to the next near-term contract expiration, and as a result, we're getting some speculation again by these paper traders that also happens to correspond with the ongoing ever-increasing strong fundamentals for gold and silver, particularly with all of the currency risk within the Eurozone and around the world as well too. So from a near-term perspective, I think that the background looks good because you have both the physical buyers and the stackers continuing to do their thing, and then at the same time, the paper guys are coming back in and speculating to the upside. And to top everything off, we still have ongoing rumors and speculation that India is going to further liberalize restrictions on imports of gold, and that will be a pretty strong impetus to higher prices in the not-too-distant future going into March.
And touching a little bit on the topic of the Eurozone, we were chatting before the show, quite interesting development as the Greek finance minister has basically let Europe know that apparently the rest of the European finance ministers hadn't taken the time to notice, but the Lisbon Treaty requires that in order to kick a nation out of the Eurozone, such as Greece, all of the nations, including Greece, have to unanimously agree on it, which means that Greece's leverage is obviously quite substantially increased. What are your thoughts on that development, Eric?
Yeah, it's a fascinating point, and Alistair McLeod wrote an analysis about that, posted earlier this morning, so we'll link to that as well. And the bottom line is that both sides are playing chicken, and both sides have leverage, and when it comes to European parliaments in Italy and Spain most particularly, were there to be some kind of grand bargain where Greek debt was nullified by 50% or higher, that it could very well likely inspire mass protests in Italy and Spain to the threat of the Eurozone overall. So there's only so far that Greece's finance minister can push without actually triggering those kind of conditions that would, in a roundabout way, put a check on his political flexibility. And then from the flip side, from the European perspective, they're dealing with the prospects of what may happen, what would happen if Greece was to default outright on the majority of its debt. And it isn't just that, the risks are that, we have most of that debt in institutions like the ECB and the IMF and whatnot, and no longer housed primarily within the banking sector overall. And some people were making the argument that given that fact, that Germany and other strong negotiating-minded players in the Eurozone would stand firm against Greece for not fearing as much about the banking system, because the debt is now primarily housed in the IMF and the ECB institutions versus the financial sector. And we know how our oligarchs love to protect their banks. But the fact is that you have to layer on top of that a very large amount of credit default swaps exposure that in fact goes directly into the heart of the banking system, because those are the guys that created those contracts that are now floating out in the wild. Ultimately, Greece only has funding to carry it through a portion of March, and the negotiations that have gone on back and forth, where we've had this supposedly an agreement made and then backpedaling and nothing of great certainty for this transition period actually coming into a final agreement just yet. It's just been one grand can-kicking experience, and it's going to remain that way, I suspect. And the assumption I have been operating on is that there would not be an ability to kick the can down the road with a new program sometime in the final negotiations for June, because that's this interim period that both parties have agreed upon. But I'm even beginning to second guess that the parties might even be willing to try to do some kind of a can kicking even in June. That's how absurd these things have been. The only
if that happens, though, Eric, what does that imply for Portugal, Spain, Italy?
Exactly. That's the real big risk factor. And
you're not going to just watch that and not come to the table as well and say, hey, guys, we'll take that same deal?
Well, they'll demand it through the voting population, and that's I've identified Spain probably as the next black swan, and people really aren't looking that much at this stage. But they're going to be voting in September, and the Podemos party over there has now suddenly risen to favorable polling of 30% of the population from nowhere. These guys are an outright socialist party, and it's kind of interesting that some on the right reject the austerity programs, and some on the left reject it. And in the case of Spain, with the long tradition of leftist movements, it could very well be that you will see Podemos winning in the September election, and that could upset all of the calculations for the grand designs of keeping the euro currency as well as the political union together. People, think, political union will never fall apart, but with all of these dynamics developing, I think that it's actually a realistic possibility. So all of those things will obviously be very bullish for gold, because you'll have large populated countries peeling off from the Eurozone, in the very least, when it comes to the currency, if these things were to transpire. And that's a heck of a lot of people that would suddenly be experiencing their domestic economy is shooting higher with inflation, because their own central bank will start printing domestic currency to pay off their debts. And that would greatly devalue their currency, and a heck of a lot of people, to the tune of, if you add Greece and Spain together, you're talking about nearly 100 million people, predisposed to buying more gold. We've already seen a big move in gold in the last 3 months in the Eurozone, and I don't see any reason why that's going to stop. There definitely is a lot more interest amongst Europeans to park some cash in gold, and that's been part of the reason why we turned around as we did in the fourth quarter.
So are we in a situation here where, for really the majority of 2015, we do have a potential to have a continued rally in the dollar, as well as the precious metals moving higher?
Yeah, I think that that's the case. And at some point, the dollar could get its wings clipped when people begin to appreciate that the Fed is not likely to be anywhere aggressive at all when it comes to raising interest rates. And in fact, the expectation for the Fed to start raising interest rates in June, as of expectations set last month and a few months prior to that window of time, that's where most people, be they economists and strategists on Wall Street, were thinking the Fed was going to move. Some 65% or so of expectations of people. and that is now declining because of the latest FOMC minutes release talking about how there's all these various risk factors that the Fed is concerned about, and their Fed itself is actually decreasing expectations for a June interest rate hike. So, if as I look at the economy and see that even by government numbers, never mind, shadow stat statistics from different perspectives, the economy is rolling over. We have a great deal of indications that that's happening. The University of Michigan Consumer Sentiment, fell the most in 16 months. Home sales are rolling over. The fourth quarter GDP, which was expected to be coming in at, looking at the numbers here, just make sure I quote the right number, it was expected to come in at 2.64%, but it only registered at 2.18%, and that's, the typical revisions that they'll be doing when they produce these numbers. But the point being is that that's after the third quarter report where they made a big to-do about the 5% plus growth rate that was largely driven by people dodging from Obamacare and having to spend more money for their insurance coverage, and employers, in fact, having to spend more money and driving all of that spending. It was like, the nation is dipping into its savings piggy bank to pay for something that's suddenly become more expensive, and that's considered growth. It's crazy. So, bottom line,
and we even had the truthful Freudian slip by former Fed Chairman Alan Greenspan yesterday, saying that, really comparing the current demand of the economy to the late stages of the Great Depression, pointing out that, the stock market has been great and rallying for the past couple of years, but Alan Greenspan himself came out and compared the current actual economy to the late stages of the Great Depression. And this isn't a Tyler Durden or you and me on Silver Doctors. This is the former Fed Chairman, Alan Greenspan.
Yeah, and this kind of continues on with his pattern in the last year of saying, well, gold would be a great idea to put some money in, and all of this various truth-telling that he's suddenly doing now to kind of resurrect his reputation. In the mid-1930s, we had the stock market rebound a lot, and there was a rebound in the economy, but it all rolled over when the fiscal stimulus was going on and then suddenly was curtailed. And, in 1937, we had a revisit of the Great Depression's impact to the stock market. And I think that that's the kind of analogy that Greenspan is speaking about. And, he's right. And it's just a reflection of the cycles that we've had with QE and all the various stimulus. And, frankly, the subtext of his comment, probably can be construed as to suggest that he wouldn't be surprised if the Federal Reserve steps on the quantitative easing gas pedal aggressively at some point in the not-too-distant future. 6-9 months out, we'll suddenly see a switch in the jawboning and managing of expectations more aggressively, suggesting that QE could in fact come back, or a giant fiscal package could in fact come back. It's interesting, when Bush was in office, he did this tax credit for consumers across the country, and there was, Obama using his shovel-ready jobs program with fiscal spending. But ultimately, there really hasn't been that much fiscal spending and fiscal stimulus when it comes to fighting this new Great Depression that we're in. And I wouldn't be surprised if we see a gigantic fiscal package coming out of the Congress at some point. So it's definitely going to be an interesting year. Lots of stuff going on, and the geopolitical front is by no means getting any better. It's definitely a mess. The so-called treaty that called for a ceasefire and cessation of aggression and backpedaling in Ukraine is not going to hold, and we're probably the only saving grace, frankly, is that the Poroshenko junta over there has lost a huge amount of legitimacy when it comes to the military forces that are aligned in its own coalition, and the folks in the Donbass region have been beating them. The U.S. just orchestrated a deal to use the United Arab Emirates as a conduit to send weapons to Ukraine, and that's not unlike what was done in the Iran-Contra affair, where Saudi Arabian monies were funneled through to support the Contras, in the 1980s, and these kind of weird machinations are just part and parcel of how the United States facilitates its geopolitical positioning. So expect
to see... If the proxy war against Russia via Ukraine wasn't bad enough, it appears that Obama is trying to resurrect for the second time a Syrian invasion.
Yeah, that is... I mean, if you look at the rhetoric when it comes to what they started in early January, talking about Syria having an undeclared nuclear bomb program, to the machinations that they've done with the ISIS targeting groups and trying to fund so-called moderate ISIS members, and then seeing all of those members, in fact, going to the core of the ISIS Islamic Caliphate fight. This is most likely going to result in some kind of a conflict expansion, with maybe even U.S. boots on the ground, first justified on the rationale of needing to protect Baghdad and Iraqi oil fields, but ultimately going after so-called terrorists that we partially have created by our own funding and training in Syria. And I don't think we're going to exit 2015 without a heck of a lot more conflict in the Middle East.
Well, before we wrap the show up here, Eric, the one other topic that we want to go over and kind of discuss with the readers is the Aurum. We had posted the story on Silver Doctors about a week or a week and a half ago, but there's rumors that a South America central bank is looking into using the Aurum actually as a currency, which would have the potential of revolutionizing things. I mean, obviously that would be quite a significant break from current fiat currency globally if a sovereign central bank was to adopt a transactional currency that actually had physical gold embedded in it.
Yeah, it was the company itself that made this disclosure, and they did not say which central bank they were having these discussions with. But knowing the governments in South America as I do, and kind of the way they look at financial situations domestically and internationally, my best guess is they were probably talking about Ecuador. It would not be Brazil. It would not be Venezuela. Well, it could be Venezuela, but it won't be Argentina, I don't think. And so by those three countries, and it probably won't be Colombia. So we're talking there of the larger economies being excluded from the probable list of possible nations that we're talking about. And if it's Ecuador, even though a lot of people in the precious metals community would be super enthusiastic about it and jumping up and down saying that this is going to change everything, it frankly will not be a very big deal initially. However, what might happen is that it might inspire other nations to copycat whatever the final plan is. Maybe it's a parallel currency. I mean, right now, if I remember correctly, Ecuador is still on a dollarization standard, where they literally use a parity pegged to the dollar, so their local currency transacts as dollars, as well as acceptance of physical U.S. dollars in the economy too. And I don't know if they would want to necessarily break that, but it's conceivable that they could easily do a parallel currency introduction and then make subsequent decisions thereafter, depending on what the market reaction is to the introduction. So it's a very interesting story, and to remind our listeners as well too that may not remember what the Aurum currency unit is, it's a piece of paper that has embedded within it the gold foil that represents the dollar equivalent weight roughly. I mean, there's volatility within a gold price market, of course, but that approximates roughly the face value of whatever the currency unit is claiming to represent. And therefore, it's a physical way to actually have currency literally backed by gold, as opposed to a promise by a government to exchange gold for paper fiat once it arrives at the bank window. So it's a very interesting development. Definitely needs to be watched, because if it does end up coming to pass, that will be one more nail in a coffin of this overall currency war that's going on, and how people's expectations and feelings about gold will be shaped. I mean, it will be very difficult if 2, 3, 4 countries around the world for people to say, oh, gold's just a barbarous relic. I mean, we already have examples of countries like Iran and others that are on the fringe, and Russia making use of gold through the transactions in the economy today, and that would add on to basically an exit of gold being a barbarous relic as being the meme that most people believe in. So it's a story to watch going forward. And I do want to say one other thing about all of the talk these days that we're seeing more governments considering investigating gold manipulation based on the fixing price. And our longtime listeners will remember that when the announcement about the gold fix ultimately going to be shut down was made, that we did a show that very week. I think it was even 24 hours after the announcement, and I spoke down about how this is not going to mean much of anything with respect to gold manipulation, because the fixing, the London PM fix and AM fix, really is trivial compared to the big guns of what the cartel uses to manipulate gold and silver. And in an ironic twist, and I noted this even back then, that this whole discussion in the media about how regulators in various countries are going to get serious about going after banks for the fixing manipulation that they've done is nothing more than a limited hangout. And the intelligence community and politics is a concept known as limited hangout, where you admit to some failing or disclose some truth in a limited fashion so as to distract from the main problem. And this is something that people in the precious metals community need to keep in the back of their mind, because basically we're being fed a bunch of bullshit when it comes to governments getting serious about going after regulation. That's what the story is in the mainstream media, and the conventional thinkers on Wall Street are lapping us up, not even thinking critically about it. The bottom line is that this is a way for the regulators to distract from and wash their hands and absolve themselves from any responsibility for dealing with the real centers of manipulation against gold and silver. And there's been a lot of discussion about that in the last week, so I wanted to throw that out there as a final note.
All right, well, as we close the show, we'll look forward to the week ahead. Gold really needs to get back above 1230 to see the move start to make back towards the 1300 level. It'd be nice to see silver get back above 17 next week. I personally think both of those levels are achievable next week, so we'll see how the market trades as China gets back into the market, first full week back from the new year.
Yep, I agree with that assessment as well. And we're still in a seasonal strong period for accumulation, and India is going to be buying quite a bit, because a lot of the dealers that do their importation for their markets have been sitting on the sidelines knowing that the Indian government is going to relax duties, so they've been stalling their buying. And India's buying in the last 6 months has been monumental overall. So, the Indian buyer is definitely back. They're buying more than China in the short term, and it'll be interesting to watch how that develops over the coming year.
And we'll definitely keep our eyes on India as well. I forget the exact date, but it's within the next couple of weeks that is expected that they will relax their duties, which would, again, be a big boon to the physical gold market as India, massive Indian demand comes back. All right, so we'll wrap this week's show there. For the Doc and Eric Dubin, thanks for tuning in to this week's SD Weekly Metals and Markets.
Those individuals who are in charge of monetary policy around the world, I think they're very much aware of what is coming. When I've asked Federal Reserve Chairman in the committee about this, they never said, no, that's not going to happen. They used the word orderly. As long as it's orderly, it seems to be okay.